GameStop's a stock that struggled for a long time. The company's had challenges, and that led to a fairly low share price. It also leads to a situation where certain investors, especially hedge funds, will look at that, and to make money on the way down, they end up borrowing stock from somebody else to sell it, hoping that they can buy it back at an even lower price. So if enough of that has happened, then what can happen is if a few people start buying and the price rises a little bit, now everybody who was short has to cover that. So they got to scramble to buy back shares. There aren't that many shares available. Others are buying too. And it just builds this momentum of buying, and the price starts running and running and running. And eventually you get this momentum where there's a dramatic spike in price. The key point in a situation like this, where there are a handful of stocks that are showing this dramatic, fast-paced movement, is yes, some people are making money. A big part of what was happening here with GameStop was that certain others were losing a lot of money, and they were scrambling to stop the losses. So right off the bat, you can see that there is big opportunity and big risk. The opportunity is if you jump in at the right moment, you can see a rapid gain, and that's great. But then the pressure is going to be on to sidestep and get out before it reverses, which is a possibility. And here it's February 2nd, and GameStop has fallen dramatically. So there's a lot of pain happening right now. There's a lot of celebration with people who made a quick buck or a lot of bucks, but there's also a lot of pain. We don't make a practice of short selling. We view it as very risky. It's a type of trade that actually has a risk of unlimited loss. You can lose even more than you have invested. So because of just the extreme risk and the fast pace at which those losses can materialize, we stay away from short selling.